All right, good evening, guys. This is Ken at Tortoise Capital, and we have just a few questions to cover tonight, and a couple explanations. And I want to give you a demo of a prototype MACD histogram swing trading screener. I posted some sample chart in the chat room today, so I want to give you a view of what that's going to look like. So let's just go ahead and get started. Let me make sure you guys hear me okay. Okay, great. Okay, so this one was from Brian Lancaster. There's Brian. Hey, when we have more signals than you want to take from a single system, are we better to shrink the universe, such as taking signals from the S&P 100 or the ETF 30 instead of from the S&P 500? Or are we better to target signals that come from the best performing spiders? Well, I take this general approach whenever there are more signals than capital, or the number of signals is really exceeding my span of control. When that happens, what you normally see is that you have the market itself is probably in some kind of pattern condition, and in those cases, the market seems to be what's more important than individual sectors. So let me draw a sample on here. So you guys have seen this diagram before, where the market is worth 50. It's worth 50% of the stock's performance. The sector is worth 25%. And the company itself is only accounting for about 25% of his own variation. So what that means is that there's a very strong correlation between the markets and the sectors, and the sectors and the companies, right? So when you have a lot of signals, chances are you're getting, let's say you had 5 days down, and you had 20 members of the Dow, 20 companies were all signaling 5 days down, and you had 50 of the S&P 100 and the majority of the ETF 32. And then the market itself is probably in a 5-day down as well. So when that's the case, to me, the market is what's in the condition, and it's being reflected in all of the sectors and all the companies. So whenever I see a single system has a plethora of targets, and I see that the market itself is in that condition, then what I want to do is basically get the market right, because I believe that the market condition is going to attract really big money. When really big money that needs the full size of the market in order to accept their size, then that's the first place I think that money goes in, and then the rest of the sectors and the companies tag along. Now, they may be more volatile, but I want to make sure that I get the market condition right. And so that's where I will use that kind of radar screen where I have the S&P right in the middle, and then the Dow and the Russell and EFA and tech, and then VIX. And then I might have this constellation of 5 sectors from the sector spiders, like finance, tech, uh, basic materials, energy, and like staples, right? ELP or XMP. So, and then and only then will I go out to the individual companies. So, the more it looks like it's a market kind of a condition, the more I want to get the sector right, and I think that's where the sustained power is going to be. And then I will quickly check the other those sector spiders and see which one of those is really dominating. And if it's like tech, then I'll come out and try to get the company. So in the case where there's a more symbols than money, I'm going to try to get the direction of the market correct. Now, if the market is collapsing, then I'm going to go right to VXX or the financials or the triple Russell 2000, because one of those three, financials, small caps, or the VIX, the volatility itself, one of those three will really be dominating, and that's usually enough. But if the market's going up, then I'll check to see which of the 5 sector spiders are really working, plus the it may be IWM. I'm going to add EWZ in here. Brazil might also, it's uncorrelated enough that it belongs on this axis of indexes. So that's basically what I will try to do. And that really corresponds with my, my favorite targets, if you will. Get the market call right, and then get the sector call right, and then, and only then, try to maybe find a symbol that's really leading the way. But if you can get the market or the sector, you'll be tied into to 75% of the true story. And then companies are icing on the cake. And so my priorities of targeting are kind of like this. The big fat indexes like the Dow, the S&P, the Russell, the VIX, Brazil, and then it's individual components of the Dow 30. Then it's those sector spiders and ETF 30. Then it's S&P 100 stocks, and then the other maybe liquid ETFs. Okay? Does that make sense? Right. The next question is from Jake. Why would stretched or pinch targets be best traded on 30-minute or 2-hour charts? And the basic answer on that one is really, I think, pretty straightforward. So pinch and stretch, those are swing targets because those are computed on the last 30 days. The last 30 days of performance. And so like a pinch means that the Bollinger Band, the distance here from the width of the river is extremely narrow, and that means this thing is ready to break out in either direction. If it's also a Z3 super pinch, that means that the RL 10, 30, 90, and 270 are also all contained inside a pretty narrow range. So we're getting a combination of lack of volatility and then consensus on price agreement, which comes from the regression lines. You put those two things together, and this thing is a time bomb waiting to explode, or a coiled spring ready to expand. So if I wait for the daily, the daily charts can happen, and that's going to be a swing trade that could last 2 to 10 days pretty easily. So the breakout would be like from above Z3. Well, if you dial down to 30-minute or 2-hour charts, you're still on a swing time frame, in my opinion, but you're going to get a much more rapid move, and you're going to be able to fine-tune like the dragon will really be easy to see. The peaks and the valleys will be very easy to see on the 30-minute chart compared to the daily chart. Because there's 7.5 hours in the day, that means there's 15 30-minute candles in a day. And so now I have 15 segments inside here, each one building towards it. And so I may be able to actually see this kind of deal where it fails to fail further, and then I can buy something right around in here with a nice tight execution stop here. And now I'm getting that front run up to here. And this might be where the mechanical entry is on daily charts. And so, but if I can see a very orderly progression on 30-minute and 2-hour charts, for example, I may be able to front run. And I can have a tighter stop, meaning I can have a larger position size in here. Then what I can do is I can actually cash some of these, and then just use my regular swing trade size as it goes through the resistance, right? And then I can add those positions back on once it clears the resistance level at the hump of the dragon. So it's nothing more than being able to fine tune the swing trade pattern for pinches or stretches. And what you're doing is, I think of it as fast swing trading. So I think you can swing trade on weekly charts, on daily charts, on 2-hour, 1-hour, 30-minute charts. I think all of these represent possible swing trades. And so if the daily is sort of the normal, then if you can go with 30-minute or 2-hour, you're front running that. You're getting a tactical advantage. Okay. The next one, Jake gave me a chart, so I'm going to pull that one over and show. If you just bear with me half a second here. Had a good 2-hour soccer practice today. The kids wore me out. Okay, so we're going to look at the risk Z. And so we're looking at this here. So are these statements accurate? True or false? Risk Z is a way to determine what types of trade you're going to participate in, whether it's bull, bear, or side. I kind of yes, but kind of no. I agree that it's going to help. It's going to help me with a strategy of what I want to try to do. So first, let me say this. So when the risk Z is above the 0 line and rising, this is the summer. No matter what market condition I'm in, I want to be long because volatility is declining. This could be a sustained decline in volatility at the end of a bear move. And so this is where the leaders in the swing trades are starting to emerge. And so now let me add your refinement, and now that I've said that. So in bull, building swing positions in a quieting, it may not be quiet yet, but it's getting quieter with good follow-through expectations. I would agree with that. Now, if this was a bear, take swings with the expectations of not as good a follow-through as in a bull market. I would also agree with that. And I would take fewer positions. I would be readier to cash the win rather than holding out for more. My expectation is that the thing will come to an end rather than continuing to just quietly chunk along, and that's until it gets into the bull market. Okay. On the far side of this one now, the second leg, this is the risk Z is above the 0 line, but the slope is declining. In bull, not taking new positions and managing current positions closely. I would still take some positions. I would not try to be at maximum heat. If I still had a good position and I could tolerate the portfolio heat, I would still take them. But I would, I would certainly not take any shortcuts. I would watch for my correlated positions and total portfolio heat. I think you can still take them, but I would be more cautious. The next one is when we're in the winter, day trading, regardless of whether it's bull or bear. That's the emphasis, absolutely. And this is ideal time for day trading on the short side in bear markets. If I was ever going to swing trade in bear markets, then it would be, or if I was ever going to swing trade bear markets, it would be when the risk is at that condition. So that's the winter. Now this one is the spring. The MACD is, or the RISI is below the zero line, but starting to rise. Still day trading, whether bull or bear, yes. In bull, beginning to consider any swing signals, I agree. I would also try to do core and turbo here with the swing trade. So I might try to earn some money with the day trade first and then leave a position at swing trade size on overnight, using markets money to fund the risk. That's what I would do. Now in bear, beginning to consider swing signals that are moving off the bottom. Yes, I think you can be patient with that. I would take half my portfolio heat on that one. I would still be primarily day trading, but I might take one or two positions that had made money intraday and maybe try to hold those overnight with a swing. But in a bear, I would be trusting the volatility of bears most of all. But that's not a bad notation. Okay, is that clear, Jake? Oops, hold on. Let me check with. I gotta expand the question box. Is can I address the second hump of the green bars toward the right of this chart? Yeah. All right. So what we have. This is why when I talked about the in the fall that I'm still willing to take swing positions, because this is one in the fall. There are times when you get this bimodal hump that this is sort of the it gets its second or third leg. Now the fact that this is already at 1.5 makes me a little concerned here, but when you get this kind of a move, you can get a nice sustained move out of that, and there actually was one about 3 weeks ago when you got that second leg up. And even though this was declining right here, followed by this little bump, this whole period from here all the way down to here was actually a really good grinding swing. Right, this whole period of time, and so that's why I'm willing to take swing positions. I'm just managing them very carefully. I'm more willing to take partial wins, let's say intraday, and then putting it back on with turbo the next day. But that I take that as a really good sign, because I look at it as a excuse me. I look at this as a like finding a support level with a dragon. You know, you had a support level here, and then it made a higher low here, and then this little resume. That's like a continuation pattern. If you looked at this like that, you say, oh, that's like a little pocket in here. And so that makes a very favorable move. In the same way, this one that found support and had a little bump above the zero line, I'd take that as a win as well. Both of those I look at as pocket opportunities. And you would see that the MACD histogram indicator we're using. That's one where the MACD histogram would have gone up, or the MACD line would have gone up, crossed its 5-period EMA here, but didn't come all the way down to the zero line, and then reversed and went back up. And so you have this kind of action. that creates that little pocket in here. That's very favorable. In the same way that just in the the RL10 and the Dragon, that's just that continuation and pocket. So that's a good sign. And both of these points here were good signs. Okay. Yeah, you could almost think of that like as an Indian summer. Looking for a strict definition, would we switch from fall back to summer and then to fall again? Yes, treat it like a Indian summer. A bounce above the zero line is yeah. So here's the way I'm going to show you here on the Mac. Let me just go ahead and show you this little MACD histogram spreadsheet that I'm building. I was trying to get it done before tonight, but I'm about 90% of it done, maybe 95%. So with your permission, I want to let me just go ahead and show you that. It has a little bit, I just have some auto classification yet to do on it, but I think you'll see what we're getting at in terms of strict definition, since you said the magic words there, Glenn. All right, so what I wanted was some way to take care of swing trades using the MACD histogram. All right, so I'm still fiddling around. This is a primitive spreadsheet, but you can see where I'm heading with this. So on this one, the primary tab is this MACD, and this is where I'm keeping all of the administrative parameters up in here. So it's as I'm using IQ feed for data as of today's date. I'm going to use a fast moving average and a slow moving average, so the 10 and the 30. And I put this up here so that if I ever wanted to change those parameters and do something like a 824 or a, I don't know what, whatever you want to do for fast and slow, 8 and 32, or change the EMA of the MACD histogram, then you can just change those numbers inside here. Okay. So then what I'm going to do is I'm building all my my little populations, and so category, this is going to be a category, and category 1 is like the ETF 30. Although I only have 29 in here, I got to replace XIV in there. I haven't done that yet. So category 1 is all those ETF 30 usual suspects, and then I went back 530 days to compute. So this symbol here is computing the fast moving average minus the slow moving average. So the 10 minus the 30. And that generates these numbers. So this goes from 530 days of, because I was going to use 30 days worth of look back. So this gives me 500 sets of 30 days. I wasn't sure how many I needed to go back, but so this then goes all the way down to the 0 day. And then I was just testing. I wanted to test the different chart formations and then compare it to what I could see in TC2000. And then I started practicing with, I ran a separate line above here. I wanted to see what would happen if I did a MACD histogram, but instead of using simple moving averages, I used the actual regression line. So the 10-period regression line minus the 30-period regression line. And it turns out that that is too fast to give good signals. good persistence signals, it goes too fast. And so it turns out that the simple moving averages are quite good. So this one plots the zero line in orange. It plots the signal line in this blue. It computes a 5-period moving average here. And then I was just checking to see the regression line on it, just for the hell of it. And then, so this is DIA. So when we get and look at DIA, we should see the signal line right at 0. And so if we call that rascal up, it should be at the 0 line. Let me see if I can find it here. It turns out that it does. We'll get to that. It's slow to load right now. So this tab, the MACD tab, is just computing the MACD line itself. Then the simple moving average tab is computing the same thing, only it's now computing simple moving average. Okay? And then this one, then we're computing a Bollinger Band. We're computing a Bollinger Band on the moving average. So this one computes the simple moving average, and this one computes the standard deviation of the MACD line so that we can then build the Bollinger Band period. So what I'm doing is because I'm doing this in Excel, I'm error stepping my way all the way through this. What I have now on these 4 tabs, the MACD line, the simple moving average, the moving average of that Red River Bollinger Band, and then the standard deviation of that, so I can compute the width of the Bollinger Bands each day. Those are the elements that I need to construct the charts. So now when I was thinking of doing some auto charts on this one. So all I want to do is I capture just the last 10 days. So like on DIA, I just captured the last 10 days of the MACD line, the simple moving average, the Bollinger Band +1, the Bollinger Band mean, the Bollinger Band -1, and it looks at the standard deviation of it. And then I'm computing the Z-score, because now once I've built that MACD histogram, right, and the or the MACD line, it's going to look something like this. So let me get a pen here. So it's going to compute some kind of line that looks like this. And then it'll be some kind of like a 5-period moving average of that thing. So that gives me almost like the P1. And then it's going to show, oh, I never knew that. Right mouse click gives me the pen right away. Awesome, I never knew that. So now let's say I'm going to compute the 0 line right here. So we remember, look, when the signal line is below the 0 line and the slope is falling, here's how I'm going to do that. If the MACD line is below the 0 line, I'm going to give it a rating of 0. And if the slope is negative, in other words, if this point is lower than that point, it's also going to get a 0. So 0, 0 is winter. We're going to see that in a filter here in a minute. So it's this reading right here is below the 0 line, so it gets a 0. And the slope is downward, so that also gets a 0, and that's a winter. Now, when it comes over here, we're going to see the MACD line is still below the 0 line, so that's a 0. But the slope is up. That's going to get a 1, and that's going to be the spring. Okay. When it gets above the 0 line, when it gets above the 0 line here, then that's going to be a 1. And then the slope is positive. That's going to be a 1. A 1 and 1 is going to be the summer. And then when it, somewhere up in here, when this thing rolls over and starts coming down, it's going to get 1 because it's above the 0 line, but it's going to get a 0 because the slope is negative, and that's going to be fall. So in the case where we just looked at it, where instead of failing, it did this. So somewhere right around in here, the fact that the slope got positive again, that's going to be a 1, 1, and that's going to equal summer. So the fact that this thing turned, instead of it coming all the way down here, it reversed and went back up. That's like a pocket or a continuation. So those are going to be the 4 categories of seasonality. All right. And now what we have on this is, because I have that standard deviation, I'm doing the standard deviation of that MACD line. I can now compute the Z-score because I will find the 30-period moving average of the MACD line itself, and then mark off that plus or minus 1 standard deviation. But that gives me a Z-score of -1. So it's like this, the Bollinger Band mean is 0, and then the width of the river is +1 and -1. So by computing the Z-score, I can always tell you where inside the stack the MACD line is. Okay, so that's sort of the idea. Now on the reports tab, that's generating all of these the last 10 days. So when we get to the last 10 days, that's where I think I'm probably gonna take the Dow 30 and probably create some auto charts for a bunch of things. I was getting ready. This one was for the Dow, and so I'm just going to do a simplified chart. All this one, was a prototype of the auto chart, and so it was going to be the blue line was the MACD line. This black line here was the EMA 5, and then you had these 3 red lines were the Bollinger Band mean, and then Z -1 and Z +1, and then you also had the pure 0 line right here, which was going to be, long bias and short bias. So this is one that I really like right here. You have the unambiguous move, which took the MACD line out of the red river, below the 0 line, then had like a P1. I think of that as the same. That's like it's not a regression line crossover, but it's an MACO, the MACD crossover. And then here's the these 3 red lines create the Z-score ladder, so I can tell by inspection where these things are. So whatever, you can see this one right here, whatever symbol that is, his MACD line is high. So that's where I'm still working on that prototype, but that's sort of the strict definition. Does that make sense to you, Glenn? Sorry. Okay, so now what I'm fiddling around with, and I'm very close to being done on this one. So the reports tab then simply grab the last 10 days of each of those critical elements. So now I can do 10-day charts, and I can make a ton of those. Now on the filter, this is where I'm building in these standard criteria. So let me mark these up for you. Show you where I'm heading with this. You're getting a chance to look at the Muppet Labs here at work. So the first one is the bias. That's number 1, and that's the That's the MACD line versus the zero line, right? So if that's the zero line, and the MACD line is anything above that zero line is a positive bias, in which case it gets a 1, like EWW is above the zero line. And anything below it is minus, gets a 0. The next one is the slope, and that's the MACD slope. Is it positive or negative? So even though this is above the zero line here, the slope, because the point to point slope is down, the slope is down, so this is all negative slope. So that gets us, that would get a 0, like those three, Treasuries, oil, and VXX. When this thing rolls back up, when this was here, and now this one is higher than that, we've already got the start of positive slope, then that would get a 1. Okay. The next one is the M versus E. That's the MACD histogram versus the 10-day period, or the 5-day moving average of it. Sorry. So that's kind of this one. When this line is below this line, then it gets a 0. When the MACD line has crossed above, creates that MAC, like that P1, that's when it gets a 1. And now the last thing is on this. So if this was the 30-period moving average and the 2 Bollinger Bands, and you saw the MACD line was right here, this is a Z-score of 0. This is a Z-score of -1. This is a Z-score of +1. So this one would be, looks like it would be like -0.5. So this will tell you where everything in the stack is. So here's the one that I want, the little screen that I ran yesterday. I want things that are below the 0 line, but have hooked up, have crossed their the 5-period EMA, and then in the Bollinger Band mean, it's less than the Bollinger Band mean. Because what that means is that if it's somewhere between the MACD histogram crossover and the Bollinger Band mean, then I feel like there's still room for it to grow all the way up to the 0. So I have a lot of room to front run, and then if it actually works and gets above the 0 line, that'll be the second leg, and then this thing will be massive. So this is essentially, like if this was the intraday, this would be the morning hook. Everybody see that? So that's the pattern that I'm looking for. So now what I want to do is I want to use this little table to help me screen just for those factors. Okay? So here's how I'm going to do that. The first thing I'm going to do is I'm just going to pick categories 1 and 2. So that's like the ETF 30 and the Dow 30, right? So now I've filtered down to just 59 out of 384 records. So the other sets 3, 4, and 5 are like the S&P 100, the ETF 200, and a bunch of other either favorites or like elements of the S&P 500 or something like that. So it's each one of those gets more and more broad. But for right now, for my purposes, I really just concentrate on sets 1 and 2, the ETF 30 and the Dow 30. Oh, by the way, what I'm going to do with this blank column here is that I'm using this column to concatenate these numbers, 0 and 1, and then I'm going to use a lookup table so it'll auto-populate the season. So it'll read 0 and 1. It'll say, oh, that's the spring. the 0 because it's below the 0 line, and 1 because it's positive momentum. So that's exactly what I want. And that's going to read as, spring. So what I want is, and I'm going to do this, I'm just going to do this manually here now. So I'm going to pick things that have a 0. I want the slope to be positive. I want it to be, I want the MACD line to be above the EMA, so it's the most recent little urge has been up. And then what I'm going to ask for on the MACD Z-score is I'm going to use a number filter, and I'm going to say I want it to be less than, I want it to be, don't let this thing crash, that would suck. I want that thing to be less than or equal to 0. Well, this doesn't look good. Not supposed to do that when we're working. Well, still a work in progress. When I run that one, that's going to give me those swing trade patterns that have sort of like a weekly hook. Oh, there we go. So it's less than or equal to 0 on the MACD Z-score. If I was smart, I would have just made that a little macro and clicked a button so that it would automatically run this filter for me. Next time I do that, I will remember to do that. So it's not cooperating because you guys are watching. So there will probably be a half a dozen symbols that hit this criteria. Boy, nothing's working right for me right now. Okay, there we go. So let's take a look. So these are the biases were all 0, so that means the MACD line is all below the 0 line, but the slopes are all positive, and the MACD line is above its 5-period moving average, and the Z-scores are all less than 0. So what I'll do is I'll then sort this smallest to largest, and then Home Depot is the one that is the furthest away from his own Bollinger Band mean. So this is one that theoretically, if this is correct, or if I didn't screw anything up in here, then he should be not quite inside his Red River, but that one would be very attractive to me. So Home Depot, let's see if we can get this rascal running. Thanks for your patience, guys. I have to re-log in. Now, there's going to be some other filters that I can build off of this. Like, I'll be interested in things that go all the way through the river and emerge the far side. I'm going to want to get a daily alert on anything where the bias changed from negative to positive or positive to negative. I'm going to want to know when those swing trades that we're in roll over and that the MACD slope goes from summer to fall, so that I know that I should be looking at harvesting, right? So there's a couple other derivative reports off of this that are going to matter. So let's take a look at Home Depot here real quick to see if everything that I said was true. Sort of the moment of truth. And oh yeah, it's not quite as I thought, but so you can see that actually the MACD line is below 0. It has crossed above his EMA, He's outside of his river, and the Z-score is about, if that bottom red line is -1, that's why he's at about -125. So I was actually expecting him to be down here like this. That's where you would also see the same pattern. But that's actually one that is in the same condition. So I actually don't like that one as much. Let's take a look at the next. The next one is silver. So let's see what we can see. Where's silver? Yep. Oh, love this. Okay, so it's not quite above his EMA. This might just be a difference between the way my system is calculating the EMA and the one at TC, but it's pretty close. But you can see this is outside the river and down. So this is one I actually don't mind at all. This is one where if that doji collapses, I don't mind getting short silver there at all. But if we get a positive move up, I could actually start trading that on a daily basis because it's a long way to the Bollinger Band mean and the fair value, right? So this is, silver would actually be a high priority trade for me right now with that pattern. It is at an extreme, but it closed in a doji. So let's try to find, here's McDonald's and DWDP. So let's look at both of those. MCD, where we at? McDonald's is kind of in a perfect shape right here. So you can see that the MACD line is below zero. It just crossed above his 5-period moving average. It's almost at the edge of the of that river. So it's, in my system, it's -0.92. On this one, it looks just outside that river. So there is probably some discrepancy between the way they're computing that and I am, but it's close enough for jazz. And then you can see there's a long run for it to get back to fair value. That's way up in here. So I like that the RL10 is turned, the baby dragon is turned, the dragon is turned. We have an RLXD here. It had a bottoming tail which found support, and then today was actually favorable. So I actually don't mind buying the second day of momentum on McDonald's because it didn't fail like that, and this was a Monday. I really like McDonald's there as a tactical trade. This is one that I would really like to trade as a on a 30-minute chart or a 2-hour chart, thinking that I would target 162, then the edge of the 200-period moving average and the fair value around 165. I think there's room to trade this. And you can see there's already been one favorable surge up already that went from 155 to 161. So there's room in there for McDonald's. So in a nutshell, that's what I'm trying to do with these making strict definitions out of this MACD histogram indicator. This is the way that spreadsheet is working. I still got a bunch of work to do. Now, the nice thing about this structure is that I will do all my filters and my queries on this table, and it doesn't affect all of these other computational ones. I'll end up hiding or protecting so we can't screw that up. And then all we ever have to do is just work on the filter page. And then I'm going to build some buttons in here that lets me run through standard screens. And then what I think I'm going to end up doing is having 4 boxes, and it'll group all of these symbols into the 4 buckets of the seasons, sorted by Z-score, I think. And then that will give us a very handy way to monitor the seasons of all these different symbols. Okay, so that's everything that I wanted to talk about tonight. Give you a preview of coming attractions, and let you take a peek behind the curtain at Muppet Labs as I start working through the indicators and whatnot, how the mind works. Okay. That sort of gets us into similar positions or similar ideas as the uh, um, the pinch and stretch. That's where this stuff kind of comes from. My personal opinion is that between pinch and stretch and this MACD histogram and our various the way we read things tactically, we have a sense-making framework for all seasons and all time frames, and things like the collapsing dragon, the emerging dragon, the pockets, the higher lows, that kind of stuff. The turning points that we can see in these indicators. We're getting insights that are based on pure price performance, which reflects the power of large investors and traders. And I am much more confident in the long-term robustness of those kinds of descriptions than I am, let's say, in other technical heuristics that used to work decades ago. I really think that statistical descriptions are the way to describe the behavior of these herd animals. Okay, so that's everything I wanted to cover tonight. I'll get this processed and posted. And I think that last one, that MACD histogram thing, will probably be I may just do a subset of that one and make it a lesson. I may clean it up, and maybe that was just a rehearsal, and maybe do a nice slide on it. But that's going to end up being a lesson in the swing trade. Okay, so that's everything I got, guys. Take good care, and we will see you in the chat room. Okay?